Hey everyone, and welcome back to the channel. The market has been volatile, and that means opportunity is knocking. While many investors are chasing highs, we're going bargain hunting. Today, we're diving into 3 high-quality stocks that are currently sitting near their 52-week lows and paying attractive dividends. But a low price and a high yield can be a value trap. So we're not just listing them, we're doing a deep dive. For each pick, we'll break down the company's business, analyze the safety of their dividend using key metrics, and bring you expert opinions on whether this is a brilliant buying opportunity or a dividend in danger. Let's get into our top 3 52-week low dividend stocks to buy now. Kimberly-Clark Corp., ticker KMB. Kimberly-Clark Corporation is a leading multinational personal care corporation focused on producing a wide array of essential products for health, hygiene, and well-being. Its globally recognized portfolio is organized into 3 main segments: personal care, featuring iconic brands like Huggies diapers, Kotex feminine care, and Pull-Ups training pants; consumer tissue, including household names such as Kleenex tissues, Cottonelle, and Scott toilet paper; and KC Professional, which provides these and other solutions for away-from-home washrooms, workplaces, and industrial settings. With a history dating back to 1872, the company operates manufacturing facilities worldwide and markets its products in over 175 countries, generating approximately $20 billion in annual net sales. Kimberly-Clark's core mission is centered on providing better care for a better world by innovating in essential categories that are used by nearly a quarter of the world's population every day.
At first glance, Kimberly-Clark's recent Q2 2025 results might seem concerning. Net sales were down 1.6% year-over-year to $4.2 billion. But here's the critical thing to understand. That headline number hides a much stronger underlying story. The decline was primarily due to the company strategically divesting its PPE and private label diaper businesses, plus some negative currency impact. When you look at organic sales, which strips that noise out, the picture is completely different. Organic sales grew a solid 3.9%, driven by stronger volumes and product innovation. In fact, the company was so encouraged by this core growth that it raised its full-year outlook. So, what's driving this organic growth? It's all part of a major company-wide overhaul called the 2025 Transformation Initiative. Kimberly-Clark is fundamentally re-engineering its business. They're doing 3 key things: exiting low-margin operations like those divestitures we just mentioned, investing a massive $2 billion in North American automation and innovation, and doubling down on their powerhouse brands like Huggies and Kleenex. The goal is simple but ambitious: shift resources to higher-margin branded goods and away from commodity-driven segments that get squeezed by inflation. And it's already working, with volume growth of 5% in key areas. Let's get to the numbers that matter most to investors. Analysts are forecasting full-year 2025 EPS of around $7.50. The stock trades at a PE ratio of about 15.7, which is fairly standard for a stable, defensive company like this. Free cash flow is projected to be a robust $2 billion, which is crucial because it's what funds the dividend and their investments. Speaking of which, with moderate debt levels of $7.2 billion, the company has plenty of flexibility. However, it's not all smooth sailing. The biggest challenge right now is margins. Adjusted gross margin has contracted to 36.9%, down 180 basis points from last year. Why? The company is getting hit from both sides: higher input costs for things like pulp and packaging, and competitive pressures that limit their ability to raise prices enough to fully offset them.
So should you be bullish or bearish on Kimberly-Clark? Let's weigh the opportunities against the risks. On the bullish side, brand power. They own essential products people need in any economy. This provides incredible stability. Transformation payoff. If their $2 billion automation bet pays off, it could unlock significant long-term margin recovery. Global and digital growth. A growing presence in emerging markets and a focus on e-commerce are key growth engines. Sustainability leadership. Innovations in bio-based materials and reducing emissions strengthen their brand and justify premium pricing. But on the bearish side, the risks are real. Inflation is a persistent enemy, eating into profits. FX volatility can be a headwind for a global company. The transformation itself is a risk. There will be restructuring charges through 2026, and if execution stumbles, it could hurt the stock. Mature markets are seeing slower category growth, which could cap their expansion potential. Let's talk about what makes Kimberly-Clark so special for dividend investors. This company isn't just a reliable payer, it's royalty. KMB is a certified dividend king, having increased its dividend for 53 consecutive years. That's a track record that spans multiple recessions, inflationary periods, and market cycles. Right now, the company pays a quarterly dividend of $1.26 per share, which adds up to an annual payout of $5.04. That's where that attractive 4.2% yield comes from, which is notably high for a consumer staples company. But how safe is that payout? This is the most important part. The payout ratio is sitting at about 67%. Now, that's at the higher end of what's considered comfortable, but it's still manageable. The key here is Kimberly-Clark's incredibly stable business. People buy toilet paper and diapers in good times and bad, generating resilient cash flow. In fact, for 2025, the company is expected to generate over $2 billion in free cash flow, which comfortably covers the $1.7 billion needed for the dividend. Most independent research firms rate KMB's dividend as very safe. So while the growth of that dividend has slowed to a modest 3 to 4% annually, the dividend itself isn't in any immediate danger. The income stream is secure.
So if the dividend is so safe, why isn't everyone shouting buy from the rooftops? Well, that brings us to the analyst community, and their view is decidedly mixed. The consensus rating for KMB is a hold. Out of 19 major analysts covering the stock, about 8 are in the buy or outperform camp, 7 say hold, and 4 are at sell. The average price target is around $138 to $141, which suggests a potential 15% upside from the current price near $120. The most bullish analysts, like RBC and Evercore ISI, see it going as high as $162. They point to KMB as a classic, defensive, cash-generating company that's perfect for uncertain times. On the other hand, the bears at firms like Citigroup and JP Morgan are more cautious, with price targets down around $113. Their concerns are valid. They cite weak volume growth, intense competition in its key product categories, and ongoing pressure on profit margins from inflation. In short, they don't see many near-term catalysts for a major rally. All right, so let's bring it all together. What's the final verdict on Kimberly-Clark? Well, it completely depends on what kind of investor you are. If you are a dividend-focused investor, KMB looks very compelling. That 4.2% yield from a company with a 53-year growth history is a powerful anchor for any income portfolio. The payout is very safe, and it offers stability in a volatile market. If you are a growth-oriented investor, you should probably look elsewhere. With sales growth forecasted at only 2 to 3% and modest earnings expansion, KMB is unlikely to be a home run for your portfolio. And if you are a value investor, there's an interesting case here. The stock is trading near its 52-week lows at a forward PE of about 15x, which is below its 10-year average. For those betting on an eventual margin recovery, buying at this level could offer solid returns alongside that great dividend. Kimberly-Clark is best viewed as a defensive hold to a mild buy for long-term income-focused shareholders. The dividend is its main attraction, and it's a secure one. While the near-term growth story is lacking, its valuation and high yield provide a margin of safety. It may not be the most exciting stock, but for reliable income, it remains a cornerstone holding.
Clorox Company, ticker CLX. The Clorox Company is a leading American multinational manufacturer and marketer of consumer and professional products, operating in 4 main business segments: health and wellness, household, lifestyle, and international. Founded in 1913, the company is best known for its flagship Clorox bleach and cleaning products. But its extensive portfolio includes a wide range of trusted brands, such as Glad, Brita, Kingsford, Hidden Valley, and Burt's Bees. Through a strategy focused on strong brand management, innovation, and sustainability, Clorox markets its diverse offerings in more than 100 countries, generating significant annual revenue and maintaining a prominent position in the global market for everyday household essentials. Let's start with the good news. Clorox is showing strong signs of recovery. After a tough period following a major cyber attack and a disruptive transition to a new ERP software system, which cost them nearly $580 million, the company is bouncing back. In their last fiscal year, while sales were flat at $7.1 billion, their earnings per share skyrocketed. Why? A combination of recovering from one-off losses, benefiting from insurance settlements from that cyber attack, and a rigorous cost-saving program. This pushed their gross margins to a very healthy 45%, showing that their price discipline and post-pandemic cost management are working. The outlook for next year is also bright, with the company forecasting adjusted EPS growth of 22 to 25%. That's a strong signal that profitability is getting back on track. And let's not forget their core strength. Over 80% of their sales come from brands that are number 1 or 2 in their category. That's a powerful, durable, competitive moat. So how is Clorox planning to grow from here? Their strategy rests on 3 key pillars. First, digital efficiency. That massive ERP investment isn't just a cost, it's the foundation for the future. By next year, it's expected to deliver up to $580 million in annual savings. That's a huge boost to the bottom line. Second, innovation. Clorox is now using data analytics and AI to drive product innovation and consumer engagement, especially in their core cleaning and health and wellness divisions. This is key to winning back market share. And third, sustainability. They're expanding eco-conscious product lines and aiming for 100% renewable energy by 2026. This isn't just good for the planet, it's smart business, allowing them to premiumize their brands and appeal to a new generation of consumers.
Because of its strong brand loyalty and the essential nature of its products, think bleach and trash bags, Clorox has a defensive quality that can be very attractive during economic downturns or inflationary periods. Now, let's pivot to the challenges, because they're significant. For all its recovery strength, Clorox has some major headwinds. The biggest one is muted revenue growth. We saw that flat sales number. Their organic growth is projected at a modest 2–4%, which points to mature categories and a potential growth ceiling. Then there's intense competition. They're being squeezed from all sides by giants like Procter & Gamble and Reckitt Benckiser, and by cheaper private label brands that gain traction when consumers are budget conscious. They also remain exposed to inflationary cost pressures on commodities and logistics, which could eat into those hard-won margins. And finally, that ERP transition isn't completely over. While it's a long-term positive, it can still cause near-term supply chain hiccups and operational volatility as it's fully implemented. One more critical risk: customer concentration. A whopping 27% of Clorox's sales come from Walmart alone. This gives Walmart enormous power in pricing negotiations and makes Clorox vulnerable to any inventory changes by the retail giant. Let's look at the main attraction, the dividend. A 4.2% yield is exceptionally high for a consumer products giant and immediately grabs attention. But the real question is, how safe is it? The payout ratio is elevated at around 74% of earnings, which would be a red flag for some companies. However, when we look at free cash flow, the picture is much stronger.
Clorox generates significantly more cash than it needs to pay its dividend. This is the bedrock of its safety. While the cyber attack in 2023 and higher costs have pressured profits, they never truly threatened the dividend. The consensus from analysts and research platforms is that the payout is safe to stable. The trade-off? Don't expect high growth. Future dividend increases will likely be modest, similar to the recent 1.7% bump. So if the dividend is safe, why isn't everyone buying? Let's look at Wall Street sentiment. The overall mood is one of patience. The consensus rating is a solid hold. Major firms like JP Morgan and Bank of America have recently lowered their price targets into the $125 to $135 range. Their concerns? A slower than expected revenue recovery and operational disruptions from the company's ongoing ERP system transition. The average price target sits around $130, suggesting a modest 5 to 10% upside from the current price, near $120. We see a clear split. The bullish case is that Clorox is a defensive, undervalued income stock compared to peers like Procter & Gamble. The bearish view warns that weak organic growth and operational disruptions could limit earnings growth into 2026. Technically, the stock is trading near its one-year lows, but it's finding some buying interest around the $125 level, indicating a potential floor is forming. If you're a dividend investor, Clorox remains a compelling pick. That 4.2% yield, backed by a 49-year streak and strong cash flow, makes it a dependable source of income in a volatile market. It's a solid hold or even a buy for those prioritizing yield. If you're a growth investor, look elsewhere. The near-term outlook is clouded by operational headwinds. Until the ERP issues are fully resolved and margins stabilize, the growth catalyst just isn't there. For you, it's a clear hold or sell. If you're a value investor, it's a mixed bag. At 21 times forward earnings, it's fairly valued, but not a deep value steal. You're betting on a future turnaround. It's a hold while you wait for those stronger catalysts to emerge.
Tyson Foods, ticker TSN, is one of the world's largest food companies and a recognized leader in the production of chicken, beef, and pork, as well as a leading processor of prepared foods. Founded in 1935 and headquartered in Springdale, Arkansas, USA, the company operates a vast, vertically integrated supply chain that includes breeding, processing, and marketing. Its well-known portfolio of brands includes Tyson, Jimmy Dean, Hillshire Farm, Ballpark, Wright, and State Fair, which supply a wide range of products to retail, food service, and international customers. As a critical supplier to major restaurant chains and grocery stores globally, Tyson Foods is a pivotal player in the global protein industry, consistently focusing on innovation, food safety, and sustainability to meet evolving consumer demands. First, let's understand the beast. Tyson is a protein powerhouse, operating in 4 key divisions: beef, their largest revenue generator but currently their biggest problem child; chicken, a core segment that's recently shown an impressive rebound; pork, a steady contributor; prepared foods. This is the home of your Jimmy Dean sausages and Hillshire Farm lunch meats, a segment known for its stability and strong brands. Now, on to the financial health check. For the last 12 months, Tyson posted over $54 billion in revenue. However, that massive top line translated to a net income of just $784 million. That's a razor-thin net margin of about 1.45%. This highlights the low-margin, highly competitive nature of the commodity protein business. But it's not all bad news. The company has a manageable debt-to-equity ratio of 48% and holds over $4.5 billion in liquidity. This is a crucial safety net, giving them breathing room to navigate the industry's notorious volatility. So, what's happening right now? Recent quarters have been a tale of 2 Tysons. In Q1 2025, we saw sales grow 2.3% and, more impressively, GAAP EPS skyrocket to 237% to $1.01. Q2 followed with an EPS of 92 cents, beating expectations. The star of the show? The chicken division, which rebounded strongly thanks to better operational yields and solid demand. This good news is helping to offset the severe weakness in the beef segment, where tight cattle supplies and high costs have forced Tyson to actually close plants in Kansas and Arkansas. Meanwhile, the prepared foods division, with its trusted brands, has been a steady anchor, maintaining solid margins through smart pricing and brand loyalty. So why might an investor be optimistic here? Let's talk about the bull case. First, operational efficiency. Tyson's management is focused on cutting costs and automating processes. This discipline has already pushed their adjusted operating margin to 4.8% in early 2025. Second, diversification. While beef is struggling, the strength in chicken and prepared foods shows the wisdom of not having all their eggs in one basket. This portfolio approach helps mitigate cyclical downturns in any single protein. Third, innovation and growth. Tyson is investing heavily in frozen meals and snacks, with a forecast to grow revenue to nearly $57.7 billion by 2028. That's a clear, if modest, growth path. And finally, international and ESG expansion. Their push into sustainable protein and markets in Asia and Latin America isn't just good for the planet, it's good for building long-term investor appeal. Now, we have to address the elephant in the room, the very real risks. The beef segment weakness is a major industry-wide headache. Declining cattle supplies aren't a problem that fixes itself overnight, and this will likely continue to weigh on results. Then there are legal headwinds. In early 2025, Tyson set aside $343 million for a legal contingency. That's a direct hit to earnings and introduces uncertainty about potential future lawsuits. We also can't ignore demand volatility. Consumer tastes shift, and global protein prices can swing wildly, making forecasting a nightmare. And finally, there's execution risk. Tyson's entire restructuring and modernization plan depends on a stable supply chain and labor market. Any stumbles here could delay their recovery. Tyson Foods isn't a newcomer to rewarding shareholders. The company has raised its dividend for 13 consecutive years, showing a commitment to its investors even through tough agricultural cycles. The current quarterly payout is $0.50 per share, which adds up to $2.00 annually. At today's share price, that translates to a very appealing yield of around 3.8 to 3.9%. For income investors, that's significantly higher than the average S&P 500 stock. But here's where we need to pause and look under the hood. The major metric for dividend safety is the payout ratio, and Tyson's is currently sitting at a lofty 88 to 91%. That means for almost every dollar of profit, nearly 90 cents is being paid out as a dividend.
This is much higher than its historical average of around 40%, and signals that there's very little room for error. So the critical question is, can they sustain this? Despite that high payout ratio, most independent assessments rate Tyson's dividend as safe but pressured. Why? A few key reasons. Cash flow. The company has an investment-grade credit rating, BBB-, and is guiding for positive free cash flow in FY 2026, which is what ultimately funds the dividend. Diversification. Their multi-protein portfolio, spanning chicken, beef, and pork, provides a natural hedge. When one segment is down, another can help carry the load. Management commitment. Leadership has publicly reaffirmed their commitment to the dividend, prioritizing it even during their current restructuring efforts. So, while the high ratio is a yellow flag, the underlying business and cash flow generation suggests the dividend isn't in immediate danger of being cut. If you're looking for a clear, bullish consensus from Wall Street, you won't find it here. The analyst view on Tyson is overwhelmingly neutral. Out of 17 firms covering the stock, a whopping 14 rated a hold, with only 2 saying buy and 1 recommending sell. The average 12-month price target is about $61, suggesting a potential 18 to 20% upside from current levels. Let's break down the bull and bear cases. The bulls point to improving profit margins in the chicken segment, major cost-cutting and automation efforts, and a significant share buyback program as signs of confidence. The bears, however, are worried about persistent challenges: high feed costs, a cyclically weak beef market, and uncertain demand for exports. This split is why quantitative services like Zacks and Weiss ratings also give Tyson a solid hold grade. So, where does this leave us? Let's tailor this to different investor profiles. If you're a dividend investor, Tyson offers an attractive and likely sustainable near 4% yield. It's a solid income pick, but don't expect massive dividend growth until their profitability improves. If you're a value investor, trading at around 14 times forward earnings, Tyson looks reasonably priced. There's potential upside if and when the beef market recovers. If you're a growth investor, you might want to look elsewhere for now. Tyson is in a show-me phase, and you can likely find faster growth in other sectors.